Hello, Maverick Traders. Welcome out to your FOMC rate statement prep video. It is March 18th today. Tomorrow, March 19th, is the FOMC rate statement. We want to get you prepared for that. And in order to do that, we need to talk about what's anticipated. Well, this week, obviously, we've got a lot of central bank meetings. It starts tonight. Late tonight, we've got the Bank of Japan. They're expected to keep rates unchanged. They're still in that sort of zero interest rate policy. Then Wednesday, 2 o'clock p.m. Eastern Time, we've got the Fed meeting. And the Fed statement is always followed a half hour later by the Fed press conference. Now, expectation is for rates to remain unchanged here in the U.S. Later on in the week, on Thursday, in the middle of the night, we've got the Swiss National Bank expected to cut rates by 25 basis points. They too are still at that sort of zero interest rate policy. And then finally, we've got the Bank of England. They're expected to keep rates unchanged at 4.5. Let's go back to the US and take a look at the chart. So we have been in a rate cutting cycle. And one of the things that you need to understand about rates is that they go in trends. When the Fed embarks on a rate hiking cycle, there's more hikes that follow. When they embark on a rate holding cycle, there's often multiple no change, right? A trend emerges, then they'll cut. It happens for a while. And so when you embark upon a new strategy, they kept rates unchanged for a long period of time at that zero interest rate type of policy. This was a huge Fed mistake in hindsight. They didn't even start hiking rates until inflation had ballooned up over 7%. They were way behind. They hiked rates at a faster pace than ever before, but see how it trends. And this is what's important is the market has to anticipate more rate cuts coming because that's the cycle we're in. At a certain point, they'll pause, and then there will be a long, drawn out pause, and then maybe they'll start to hike in the future. But until then, it'll be little pauses and more cuts, and little pauses and more cuts. And that's the cycle we're in. And generally speaking, people would think, oh, well, rate cuts must be good for stocks. They're cutting rates. Well, you have to think about why they're cutting rates. You cut rates because there's general slowdown in economic activity. The unemployment rate is trending the wrong direction. There's things that they don't like, and they cut rates to try to spur on economic activity, right? They are trying to influence the economy for improvement. They're trying to get businesses to hire more people and so on. So generally, the rate cutting cycle is not really a bullish scenario. It's usually happening because something has, in essence, gone wrong, right? Whereas rate hikes are not always bad for the same reason. A lot of times they're hiking rates to try to slow things down because the economy's booming and so forth. So we are in that rate cutting cycle. Are we expecting any major fireworks? Well, not necessarily. However, when we look at where the Fed's at, and the press conference and so on, you can never say never in terms of a result and some sort of volatility event. But normally, the market has what we would call a volatility crush. There's a lot of anticipation coming into the Fed meeting, but there's not as much that's really there that influences the markets. By the time this statement comes out, they don't really change much. They don't really say much, and everyone kind of looks around and says, what were we worried about? It's the same as it's always been in essence. And that's how this one is probable to go. Now, if it follows that playbook, usually there will still be a market reaction. The markets will jump up or jump down, and then it just kind of gets choppy, fills the gap, that sort of idea. Every once in a while, you'll have a major reaction. One of the biggest I've seen happened years ago when Ben Bernanke was Fed chair. There was a press conference following the Fed announcement, and they used to do it a little bit different. They would have the statement, and there wasn't a press conference 30 minutes after, but on occasion, the Fed chair would be speaking, a few hours later. So the markets had closed. They had already gone out with their Fed statement, and for years and years, the Fed had been giving guidance that, hey, once the unemployment rate falls enough and hits this metric, and as I remember, it was like below 5% unemployment. Once we hit that, we'll stop quantitative easing, we'll stop the money printing. And that was their guidance. They said, this is our benchmark. One of our jobs as a Fed is to keep full employment. And so, sure enough, a couple years went by and the unemployment steadily declined and it hit that benchmark. And so everybody thought, well, that's going to be the end of QE. And the markets had closed and they said, well, now that the unemployment rate has hit your benchmark, is that the end of QE? And Ben Bernanke said, well, that's now become an outdated target and we're going to keep with quantitative easing. And that was a shock heard around the world, and the equity markets skyrocketed. And overnight, they're trading 2-3% gap ups, which is a huge gap up in equities. And rightly so, because the Fed basically said, we're going to keep money printing, we're going to devalue the currency, we're going to drive asset prices higher, and they kept with their QE. So you can never say never when it comes to a volatility event, but I would just mind, the data suggests that usually it's not as big a reaction as people worry that it might be. Now, as we come over and look at areas of interest, we touched on this last night in the currency recap. The US dollar is one of the better potential short setups. If we were to back this chart out, you can see we've come from a downward trend. We're kind of giving the little kiss goodbye. See this little rebound up into this breakdown zone. So US dollar looks like a short. Now it's Tuesday. Fed meeting's not till Wednesday. This is probably an actionable short pretty soon. Japanese yen also more on the short side. This is a flip-flop because this is really a risk on. When you've got yen and US dollar as shorts, and then you've got things like the Kiwi as a long, the New Zealand dollar looks strong and more of a buy candidate for further upside. So the velocity is really flipped. Overall, as I said last night, I'm not so sure I trust it big picture, but in the short term, this is where the momentum is. Crypto is just sort of dead. It's starting to break down a little bit again here in the near term, but kind of a dead market right now. Not a whole lot of velocity here. If you were going to do anything, it would be more on the short side with crypto. We've really seen kind of a questionable shift here in the FX markets. Do we really trust that it's all clear skies ahead and that the Aussie and the Kiwi should be running to the upside? Or is this a little fake out move? Well, we'll find out here in the next little bit. But from a charting perspective, I would give Kiwi the benefit of the doubt unless it just really starts to break down. If this gives us another buy signal, I would still look to trade that as a short-term, very short-term trader. And on the flip side of that, right now, I would be shorting US dollars, not buying them based on short-term momentum. So that could shift. We could reverse into an uptrend here and change the trend and change the mechanics of the market. But right now, US dollar looks like a better short into the Fed meeting tomorrow. Hope you've enjoyed today's update. Have a great time trading the FOMC tomorrow, and we'll see you next time. Goodbye, everyone.